The false promise of using U.S. historical returns in your financial planning. Oh, yes, my man Blanchett and Finke. David Blanchett over at Morningstar and Finke at the American College, previously with Texas Tech. Dateline 3/15/2021. Blanchett's with Morningstar, American College, both these guys, and Advisor Perspectives. Links in the show notes. Oh, man, this is fantastic. Relying on historical U.S. returns creates an unrealistic picture of retirement outcomes. Our analysis shows that U.S. data are an anomaly among the broader global universe and that our low yield environment forebodes lower than average equity returns. Before we get to these conclusions, though, let's review why bond and stock return forecasts are so critical to the Monte Carlo methodologies. A Monte Carlo analysis is a statistical procedure that simulates a sequence of possible future investment returns. It is common to run a Monte Carlo analysis on hundreds or thousands of simulated retirements to estimate the impact of a portfolio's spending rates on the probability of running out of money. The projection typically assumes a withdrawal of a fixed amount each year that increases or falls by a random rate of return. It is common to base a distribution on historical U.S. returns on stocks and bonds. If the return distributions of stocks and bonds resemble a bell curve, then most simulated returns will be close to the respective averages. The estimated safety of a fixed withdrawal strategy will not be accurate if the assumed average rate of return that the Monte Carlo analysis is higher than the average return an investor is likely to experience. If the mean is a few percentage points lower than the historical average, these estimates can be very far off. So you got the mean, the average, and if we're going to be, say our average is 5 and we're actually at 2, our goose is cooked, man. Or if we have a mean as the average and our average is 8, and our true average is 8, well, we could have been spending a whole lot more. Lighting cigars with $100 bills. While use of historical returns may seem reasonable, those historical returns fail two important tests. They're not representative of global historic returns, and they don't reflect the current environment. Therefore, using historical U.S. returns is likely to result in unrealistic savings or spending goals. All right, so let's, early research on safe withdrawal rates relied on the Ibbotson stocks bonds inflation chart, which includes various U.S. asset classes going to 1926. I call this a modern era, by the way. This was the analysis that Bengen used in introducing the 4% rule. Today, many advisors use the stock, bond, bill, and inflation time series when estimating required savings or optimal spending levels for clients. A longer time series of U.S. returns is now widely available for free on Robert Shiller's at Yale, his website, and I use it all the time. Tomorrow's investors may experience the same returns as U.S. investors receive historically. Global asset return data provide an even larger sample size that can be used to create a more reliable distribution of expected returns. A decade ago, Wade Pfau demonstrated that the international safe withdrawal rate, man, it's been a decade? Whoa. Wade Pfau demonstrated that the international safe withdrawal rates were often far lower than what American investors experienced in the 20th century. Another relatively new data set, and I'm not going to say it, has recently been made available for free online and includes data on 17 countries going back to 1870. I'll definitely look at that data set for sure. To demonstrate how using different country returns over different time periods can impact a financial projection, we performed an analysis using the data sets. The analysis estimated the safe withdrawal rate for a 50-50 stock to bond portfolio with a 50 basis point fee, assuming a 30-year retirement where withdrawals are adjusted for inflation. So a lot going on there. So remember, we're taking we have a 50-50 stock to bond. We have 1/2 as the fee, a 30-year retirement, and we're adjusting our withdrawals each and every year of inflation. Safe withdrawal rates are estimated for each country starting in the 1900 or 1926. The distribution of safe withdrawal rates across various target probabilities of success are included below, along with the results for the U.S. by comparison. Okay, so since 1990, if you want to be in the top, and I'm just trying to shoot for 75% because we're adjusting for inflation each and every year, your safe withdrawal rate would have been 3.4 in the median. That means 50% of the time you would have done better than 3.9. Did I say 3.9? 3.9, and 50% of the time you would have done lower. So if our success rate is 75%, 50, well, you can't really say 50. Yeah, I guess you could say 50% of the time you would have done better than 3.9. 50% of the time you would have done worse. That's a little bit dicey there. The U.S. though is 4.5. All right, so the U.S. ranked 4 out of 21 countries, I think is what he's saying. There are a few important takeaways from the analysis. First, safe withdrawal rates in the U.S. have been considerably higher than other countries. For example, targeting a 90% success rate, the U.S. historical safe withdrawal rate would be 4.2%. So we go up here. So this is since 1900. We got 90% success rate is what we're shooting for. The U.S. was 4.2. So we were number 4 out of 21 countries with a 4.2, where the 75th percentile is 4. So we were significantly better than the 75th percentile. This outperformance may persist, but the U.S. experience has been better than average. If investors in each country ran retirement projections using their historical returns, the results would have been very different. As investors across the globe hold internationally diversified portfolios, U.S. market returns will increasingly resemble those in other countries. Couldn't agree more. Part 2, bond yields are significantly lower today than their historical averages as well. We previously estimated that the surprising sensitivity of Monte Carlo failure rates to bond return assumptions. The capital asset pricing model estimates expected returns on risky assets as a function of the return of risk-free assets, thus a risk premium. Rates of return on safe bonds are known and will affect the return on stocks. I completely agree. While valuation metrics such as a cyclically adjusted price earnings metric by Shiller do not consider the impact of today's bond yields, accounting for today's yields provides a more accurate forecast of future stock returns. And so basically what the gents are saying here is CAPE ratio, cyclically adjusted price to earnings ratio. That's what it is. It doesn't take into consideration current bond yields, which is why Shiller has changed it actually. But if you're not using current bond yields, then you can't really use it. Lower fixed income yields means the returns on bonds are going to be lower. While bond yields could increase, which would increase the yield on bonds, the increased income would be offset on the decrease in price, 100%. Let's see. Therefore, any increase in future interest rates will have a negligible impact on realized bond returns. Bond yields also have a surprising relation to stock returns. To provide some context, we performed an analysis using primarily one of the previous data sets going back from 1870 to 2019. The data set includes government bonds and stock market returns for 17 countries. For the analysis, the future 5-year return on equities is estimated where all countries are grouped based on a level of prevailing bond yields in roughly 1% increments. In other words, all countries where bond yields were less than 3% at the end of the previous year would be placed in the negative, or the less than 3% bin, and so on. So this is freaking crazy interesting. So check this out. All the countries with the bond yields of negative 3%, not negative, less than 3%, are placed in this bin. Their median return for the next 5 years is 7.49, with a standard deviation of 6.34. The geometric return is 6.99. That's kind of what we want to use here, geometric returns. So if with the U.S. right now is less than 3%, I'm assuming they're using the 10-year treasury, less than 3%. The median over the next 5 years was 7.49. Remember, the median, 50% of the time you had more, 50% of the time you had less. If the bond yield was over 9%, for simplicity, all right, the median rate of return over the next 5 years was 14.31, with a standard deviation about twice that of the bond yield being less than 3. Interesting, huh? So you have a bond yield above 9. The geometric return was 16.8. That's the compounded annual growth rate. The median was 14.31. See a significant difference on future returns based on where current bond yields are at. This right here is fundamentally critically important. There's a positive correlation between the initial bond yields and the subsequent 5-year return on stocks. A regression predicting such future returns and using initial bond has a slope of approximately 1. In other words, a 1% reduction in bond yields has corresponded to a 1% reduction in equity returns. That's freaking crazy, man. Bond yields are approximately 350 basis points below their long-term average right now. This suggests return expectations for equity should be approximately 350 basis points less than the long-term average. Hallelujah. hallelujah. Now look, I've been reading Blanchett, Finke, Wade Fowler for a long, long time. And I 100% agree. Using a larger sample of global returns, more than just the U.S., it is evident that subsequent stock returns have declined when initial bond yields have been lower, consistent with a CAPM, capital asset pricing model. This means investors' expectations should be lower today to incorporate the lower bond yield. All right, so if we have a bond yield of less than 3% and we want a 75% success target rate, that means our safe withdrawal rate would be 2.8%. That's it. All right. If you want a 95% success, it'd only be 1.95. But oh, Josh, no, that'd be 4% rule. We're talking, 30% less than the 4% rule. Ah! Like the return analysis, we group the respective outcomes based on initial withdrawal rate at the beginning of a 30-year period. We estimated the initial withdrawal rate would be, well, he didn't say it, but I'm going to tell you again. We have a 50 basis point cost. We have an increasing inflation rate and a 50-50 stock to bond, increasing withdrawal rate. So keep that in the back of your mind. If we use historical periods that resemble today's low yield environment to estimate the range of potential withdrawal rates, we see that even targeting a 50% success rate is an initial withdrawal rate of 3.4. Yep. So if we go to 3.4, 50% right there. 50% with a less than 3% current bond yield. What if yields rise? It's not clear how long low bond yields will persist. Using historical data to about 1900, bond yields have been somewhat mean reverting after 15 years. In other words, they drift over time and they return to their long-term averages, which has been about 5% for 10-year government bonds globally. However, using very long time series, there's evidence that lower bond yields may persist in the future and potentially get worse. For example, some guy demonstrated that bond yields have persistently declined since 1311, and that bond yields at the end of 2018 is relatively consistent with a super long-term relation. We don't know how long this will persist. We don't know. One approach is to use an average by blending near-term forecasts with long-term average. If today yields are 1.5 and long-term yields are 5%, why not project 3? I completely agree. All right. Conclusion. Using only historical returns seems reasonable, but it creates a false sense of safety. Unrealistic future return assumptions also distort potential trade-offs when advisors are developing a retirement plan. Not only could over-optimistic projections lead to the risk of spending too much, assuming government bonds will yield 4.5% improperly discounts the benefit of delaying Social Security retirement benefits and the use of immediate and deferred annuities. I completely agree. So let's see the comments. I got some comments here because we got, let's see. An interesting approach that seems to hinge on the correlation between bond and stock yields. The obvious question that does not seem to be answered is how strong is the correlation? For example, Swidrow argues elsewhere that there is no correlation between bond yields and stock returns, but apparently is looking at current as opposed to subsequent return for stocks. I don't know. I don't agree with that at all. Let's see what Blanchett says. There hasn't been a strong correlation between U.S. bond yields and subsequent stock returns, so I can concur. This is a relatively limited data set. However, if you extend the analysis to 16 countries, there is a 5-year geometric equity risk premium based on bond yields, about 3.2%. Yeah, I'm still okay. So, oh, he says, I'm not sure. This one's silly here. You refer to the idea that U.S. returns will increasingly resemble those other countries to the extent that our tax system, other institutions, capital-based, resource-based population, blah, 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 that basically these other people are not the U.S. I get it. Moreover, where aggregate equity index is concerned, wouldn't you expect, conversely, also looking at your, that's not what I want. Okay, right here. What was the other one he said here? Oh, right here. Not Eric, this guy right here. Are U.S. returns a real anomaly? Rather than using Monte Carlo with all its limitations, it might be interesting to use the historical rate and examine when the failures occurred. Are we going to include anyone retiring in France or Germany, for example, in 1914 or 1943, without considering that to be anomalous? How about Japan in 1943? It might be worthwhile to put the historical context. But if you were in France in 1914 or Germany, did you know what was going to happen? No. And David said, I'm not sure looking back is all that instructive in terms of explaining what happened historically, especially when we don't know. We could be on the middle of the war with China. We don't know. But anyway, here's what I say. Actually, I'll come back to this because I think it's pretty important. I want to do another video on what Vanguard gets wrong in the retirement plans. But anyway, that's great stuff. So Blanchette, again, these guys are freaking just rocking in the free world. So I'd definitely like to hear your comments. Thanks now.